Hi friends, welcome to the channel JIV and CIB Made Simple. If you have taken CTP, if you are giving the examination of CTP that is Certified Treasury Professional, then I am presenting before you memory based question with explanation which were asked on 12th July 2025. So these questions will help you understand which topic are most important from examination point of view and which topic you can skip. So let's get started. I will request you to first try to solve the question on your own and then see the explanation. This will help you because it is a mix of numerical as well as theoretical question. So for numerical question, first of all try to practice on your own and then see the explanation. So let's get started with our first question that we have. The first question is, the Reserve Bank of India issues a 91-day treasury bill at a discounted price of rupees 97.50 and the face value of bill is given rupees 100. So now the question is, what is the yield of the treasury bill? Options are 9.65%, 9.86%, 10.39% and 10.65%. So friends, first of all understand the question. First remember that treasury bill are short-term government security. They are issued at a discount and they are redeemed at the face value. So you earn money by buying low and getting rupees 100 at the end. So you earn money by buying low and you get rupees 100 at the end. Right. So there is a formula that we use to calculate the yield. And what is that formula? Yield is equal to 100 minus P upon P, the face value. Right. So remember, for treasury bill, rupees 100 is the face value always. Now P is the purchase price. What is P? P stands for the purchase price. Okay. Then comes D. What is D? D stands for the tenure of the bond. And in this case, as you can see, the tenure of the bond is 91 days. As you can see here, tenure is how much? 91 days. Okay, so now this is the formula which will be used. So it is just substitute the value. So 100 minus purchase price. What is purchase price? It is the purchase price is 97.50, as you can see written here. Discounted price means purchase price. So 100 minus 97.50 divided by 97.50 multiplied by 365 by 91 into 100. So this formula you have to apply. So it will give us 2.50 upon 97.50 multiplied by 4.010989 and multiplied by 100. So ultimately it will give you 10.39%. So option number C is the correct one. Right. So I hope I request you to please remember this formula. Sometime what happen? They give you the price and they ask you the yield, and sometimes they give you the yield and ask you the price. So both way you can find the concern. So what we learn from this question is that treasury bill are short-term loan you give to the government and you buy them at cheaper rate. Like in this case, you have bought them at 97.50 rate, right? And you will get rupees 100 later. So this difference between these two number is your profit. The difference between 100 and 97.50 is your profit. And if you want to find the annual return, what is the meaning of yield? Yield just means annual return. So if you want to find the annual return, you can use the formula y is equal to 100 minus P upon P into 365 upon D into 100. So after putting the value, the answer is 10.39%. So the next time you get a treasury bill MCQ, don't panic. Just plug the value into the formula and solve the step by step. Now friends, have a look at the next question. Next question is, which of the following is not included in the computation of NDTL for CRR and SLR purpose? Right. So there are 4 options which has been given. So friends, options are interest accrued on deposit, borrowing from RBI and refinance from NABARD, Exim, etc., credit balance in the current account, liability arising from the interest-free court receiver deposit. So these are the options. So not included in the computation of NDTL. That is what it is asked. So first of all, let's go through the option number A. That is the interest accrued on the deposit. This means that interest that is yet to be paid but already due on saving or fixed deposit. So what is the meaning of interest accrued? Interest yet to be paid. But this particular interest it is already due. It is already due on saving and fixed deposit. So even though the customer has not withdrawn it, the bank owes it. So it is a kind of liability. And yes, it is included in the NDTL. as other demand and time liability. Yes, in the section other demand and time liability, other DTL, this particular interest accrued is included, right? Please remember, for example, let me give you one example to make it more clear. For example, suppose your FD earn rupees 500 interest. So, okay, so by quarter end your FD earn rupees 500 interest, right? So the bank has to pay you, so it is recorded as a kind of liability. Fine. Now let's look at option number B, that is borrowing from RBI and refinance from NABARD, Exim, etc. So this is the correct answer because it is not included in NDTL. It is not included in the NDTL. Why? Because these are the kind of loans that bank take from another institutions like RBI, like NABARD. These are kind of loan that bank take from RBI, NABARD, Exim Bank. But remember, NDTL include liability to the public and other bank. Try to understand what I'm telling you, that this particular NDTL, it includes what? Liability to the public, right? Liability to the public and other bank, not from the institution like RBI. Yes, these are loans from RBI, NABARD, Exim Bank, but NDTL does not include such kind of loan. NDTL basically include liability to the public and other bank. So this is excluded. You can think of it like this: if I borrow from my boss, that is RBI, it is not a general liability to the public or other bank. So it is stay out of NDTL. Then comes option number C. What is option number C? Option number C is a credit balance in current account, right? So these are balance other bank keep with us. It is like one bank depositing money in another bank current account. So these are called liabilities to the banking system. Yes, it is a kind of liabilities to the banking system, and yes, they are included in NDTL. Even though it is not the public money, yes, it is still a liability. So bank adjust it with asset held in another bank and take the net value while calculating the NDTL. What bank do? Bank adjust it, right, with the asset held in the other bank. Obviously, a bank A will have some asset held in the bank B. So adjustment is done, and that is why this particular thing is excluded, right, while calculating NDTL. Means that in short we can say it is included after netting off. Yes, after netting off we include it. Option number D say liabilities arising from interest free court receiver deposit. See, this is a kind of a special case. This is a kind of a special case. These are, court ordered deposit. Like when a case is pending. Suppose a particular case is pending, right? Like when a case is pending and the money is kept with a bank interest free. So case is pending, money is kept with the bank interest free. Since it is not money that bank can freely use, it is not considered a regular liability. So it is excluded from the NDTL. Because it is not the money that bank can freely use. Okay, so it is excluded from NDTL. But wait, this is the tricky part. Although it is excluded, the question asks for what is not included, and option B is a better match because it is clearly and completely excluded. So the final answer is option number B, right? So let's summarize what we have learned in this particular question. That what is NDTL? I told you NDTL means how much money bank owe to the public and other bank in form of saving, current and fixed deposit. So in short, if we talk about NDTL, is how much money the bank owe to the public, right? How much money bank owe to the public, that is called NDTL, right? In the form of saving account, in the form of current account, in the form of fixed deposit account. So basically this NDTL help RBI decide how much money bank must keep as CRR as well as the SLR. And what are included in NDTL? Remember it, very very important. So first of all, I told you interest accrued, that means interest payable on deposit. Yes, it is included. Then current account balance of other bank, right, this is included. But what is excluded? Borrowing from RBI, borrowing from NABARD, borrowing from Exim Bank, these are excluded. And there are some special cases like court receiver fund, these are excluded, right? Hope that this breakdown make it super clear. Friend, if you are looking for a study material for CTP, that is Certified Treasury Professional course, in the form of PDF, in the form of unit-wise MCQs, in the form of previous year question, you can enroll in our course. The detail of the course is provided in the description section. Many aspirants have cracked the examination by going through the course. You can also easily crack the examination. For more detail, you can WhatsApp me on this particular number. Now friends, have a look at the question number 3. So the question number 3 is on your screen. It is also one numerical based question, very important from examination point of view. Have a look. So friends, what is the question? You are analyzing a 3-year corporate bond with face value of 100 rupees, offering annual coupon rate of 12%, prevailing YTM is 8%, bond is trading as 110.50. What is Macaulay duration in year of the given bond? Yes. So what is in simple term, when we talk about this Macaulay duration, it simply means, average time it takes to recover the bond price from its cash flow. I'm again repeating, average time it takes to recover the bond price. How much time it takes to recover the bond price from its cash flow, right? So that is called Macaulay duration. So basically, it consider both the timing, it consider both the size of each payment. Yes, timing is also considered and size is also considered. Now, as you can see here, that this particular bond is paid semi-annually. You can see this word written here, semi-annually, right? So what is the meaning of this term semi-annually? You know it very well. Twice a year, right? So basically, since this bond pays semi-annual coupon, that means 2 payment per year for 3 years. So can you tell me how many period will be there? See, in every year 2 period, right? So total is a 3 year. So it will be 6 period in total, right? Total it will be 6 period. Now let's calculate step by step. First of all, calculate the coupon amount. What is the coupon per period? What is the coupon amount per period? As you can see, it is 6%, I think. It is 12% annual. So semi-annual, it will be 6%. Okay. So 6% coupon of the face value. What is face value? 100 rupees. What is 6% of 100 rupees? It is rupees 6. Right. Because 12 rupees it paid every year, but every half year, our period is half year. So every half year, you can see YTM is given 8%, but this 8% is annual. So what will be the YTM for 6 months? It will be 8 by 2, which is equal to 4%. Now have a look at the cash flow. So for cash flow, what we will do? We will create a particular table. This tabular method is the most preferred one for computing this, Macaulay duration. So first we will write period, then we will write the cash flow, then we will write PV at the rate 4%, and then we will write PV multiplied by TI. Okay, PV multiplied by time. Now, so basically these are the columns that we have: period, cash flow, PV means present value at the rate 4%. Now, so we have 6 period. 1, let me write down. 2, this is 3rd, this is 4th, this is 5, and this is 6. Okay. Now, what are the cash flow? Coupon amount 6 rupees, 6 rupees, 6 rupees, 6 rupees, 6 rupees, and finally you will receive 6 rupees along with the face value, which is equal to 106. So these are the cash flow. Now we want to calculate this is present value factor, right? So what is the present value? How to calculate the present value? So basically to calculate the present value, how do we do it? So future value upon 1 plus r whole to the power n. So for the first case we write n is equal to 1. So it is nothing but 6 divided by 1 plus 0.04, which is equal to 5.77. In the second case, it is equal to 6 divided by 1.04 chi square, right, which is equal to 5.55. In the third case, 6 divided by 1.04 ka cube, which is equal to 5.34. 6 divided by 1.04 to the power 4, which is equal to 5.13. 6 divided by 1.04 to the power 5, which is equal to 4.93. And finally, in the last case, 106 divided by 1.04 to the power 6, which is equal to 83.78. Right. So these are the present value. Now in the last column, what we will do? We will multiply the present value with the time. So what is the time? This period I am talking about. So first of all, in the first row, it will be 5.77 multiplied by 1, right? Which is equal to how much? 5.77. In the second row, it will be 5.55, this one, multiplied by this one. Okay, so this will give us how much? This will give us 11.10. In the third row, this will be 5.34 multiplied by 3, which will give us 16.02. Similarly, 5.13 multiplied by 4, which is equal to 20.52. 4.93 multiplied by 5, which is equal to 24.65. And finally, 83.78 multiplied by 6, which is equal to 502.68. So now as you can see, total present value. If you add all this value 5.55, 5.34, 5.13, if you add all of this, you will get how much? You will get total present value as 110.50. This is the total present value, or we call it summation of PV. And if you calculate summation of PV into T, so this will give us, if you add all of them, you will get how much? 580.74. Now let's apply this these two in the Macaulay duration formula. So what will be the Macaulay duration? Summation of PV into T upon summation of PV, which is equal to 580.74 upon 110.50. Okay, so the answer will be how much? 2.63. This will be the Macaulay duration. So option number B will be correct. 2.63 will be correct. Right. I hope that makes sense to you. Now let's summarize the point we have covered in this particular slide. What I told you, that Macaulay duration is a kind of average time. Right. This is a kind of average time to recover the bond price. You have to recover the bond price. Average time it takes to recover the bond price is called Macaulay duration. And it uses present value of each cash flow multiplied by time. Semi-annual coupon bond means you have more frequent payment, reducing the duration. And always remember, always divide PV into time by the price. Okay. So if the payment are semi-annual, convert period into year at the end. Right. So I hope that makes sense. I have explained each and every option, each and every step, how to go about calculating the duration. Now friend, let's look at the second part of this particular question. The question is, if yield increases, what happened to the bond duration? Very good question. Duration increase, duration decrease, duration remain unchanged, and duration become 0. First of all, let's understand what is the meaning of this duration in the simple word. I told you now that duration is the kind of average time. Average time it takes for a bond holder. Suppose there is a bond holder, how much time it will take for a bond holder to recover the money? Because bond holder have invested the money, right? So how much time it will take to recover the money, right, that they have invested in the bond? So it is not just about time. It's also about, value of future payment. It's also about value of what? Future payment. It is not just about time. Now the question is, what happened when the yield increase? As you can see, yield is increasing. The question is, what will happen when the yield increase? So as you can see, if yield will increase, then discount rate will decrease. And what will happen if discount rate will decrease? What will happen? Those future payment will get discounted more heavily. They get discounted heavily. The future payment will get discounted heavily. That means, for further payment lose more value compared to the nearer one. So it simply means, further payment will lose value instead of the compared to the nearer one. So the weight shift toward earlier payment. Weight shift toward earlier payment, right? And since weight shift toward earlier payment, so what happened? Your duration becomes short, right? Your duration becomes short or duration decreases, right? Let's go through each and every option. Option number is a duration increase. Wrong. It is wrong. Why? Because if the yield increase, future cash flow are worth less today. Duration actually fall because we recover value faster. Because as you can see, yield increasing, discount rate decreasing, future payment get discounted heavily, further payment lose value, weight shift toward earlier payment, and duration decreases. Now option number B say duration decrease. Exactly. Because higher yield means lower present value of the long-term payment, shorter average time to recover payment, and duration goes down. Let me give you one example to make it more clear. Suppose you lend rupees 100 and you expect rupees 50 next year. You expect rupees 50 next year. You have lent rupees 100 and you expect rupees 50 next year, and rupees 50 you are expecting after 5 years. In the next year you are expecting 50 rupees and 50 rupees you are expecting after 5 years. Now in this case, suppose interest rate increases. So what will happen? That 50 rupees in the 5 year is worth much less now. So most of your value is recovered today. So obviously your duration will get lower. Why it is worthless? Because if you calculate the present value, it is future value upon 1 plus r whole to the power n, right? So if interest rate is increasing, this one is increasing, so this is decreasing, so present value is decreasing, so the worth of this 50 rupees is very less. So what happened? The duration shift toward the earlier value. That's why the duration of the bond decreases. Means you can recover the amount early, right? So that's why option number B is the correct answer here. What about which of the following correctly describe it formula? So four formula are given here. Option A is portfolio return minus market return divided by beta. Option B is portfolio return minus risk-free return divided by standard deviation of the portfolio return. Option C is portfolio return minus risk-free rate multiplied by standard deviation of the portfolio return. Option D is portfolio return minus benchmark return divided by standard deviation of the benchmark return. So these are the four options. So friends, you can think of the Sharpe ratio as a way to measure how much return you are earning for every unit of risk, right? For every unit of risk, right? How much return you are earning. That is called Sharpe ratio. Basically, it compare your portfolio return to risk-free investment. So what are risk-free investment? What are the example of risk-free investment? So like, government bond. Government bond is a kind of risk-free investment. So basically what you do, it compare on one side you have your portfolio return and the other side you have your risk-free investment. Okay, so both comparison is being done, portfolio return versus risk-free investment. And then after comparing it, divide it by how much your portfolio fluctuate. That is called a standard deviation. So now the formula for Sharpe ratio is very simple. You write the return, subtract it with the rate, risk-free rate, and you divide it by the standard deviation of return. You divide it by the standard deviation of the return. So basically you are getting extra return per unit of total risk. So let's break down each and every option. First of all, let's look at option number A. It says portfolio return minus market rate divided by beta. It is wrong formula because this is actually for trainer ratio. This formula is actually for trainer ratio, not Sharpe ratio. It use beta. Trainer use beta, which only consider market risk, but Sharpe use total risk. What about option B? Option B say portfolio return minus risk-free rate divided by standard deviation of the portfolio return. Yes, it is the perfect formula. Because this is the exact formula for the Sharpe ratio. You take the extra return over safe investment and divide it by the volatility of the portfolio. Right? So what you do here, that you take the extra return over the safe investment. So this is your safe investment and this is the extra return you are getting. You take the extra, means you define the difference. So this is the extra value, right? And you divide the extra return by the volatility of the portfolio, and volatility is measured by the standard deviation. So suppose, let me give you one example. Suppose your portfolio give 10% and suppose risk free rate is 5%, okay, and the standard deviation is suppose 2%. So what is the Sharpe ratio? Sharpe ratio is 10%, which is your return. 10% is your return. Then you subtract risk free rate, which is 5%. 10% minus 5%, and you divide it by the standard deviation, which is 2%. So which is equal to 2.5. So which means 2.5 unit of return per unit of risk. So basically in the numerator we have return only. In the denominator we have risk, right? So basically 2.5 unit of return per unit of risk. So this is the option number B is the correct answer. What about option C? This they have multiplied it. Instead of dividing, they have multiplied. So it is quite incorrect. Option D is also incorrect. So what we learned from this discussion is that, this particular Sharpe ratio, it tells you how efficiently your investment give return for the risk you are taking. Means how efficiently your investment is giving return for the risk you are taking. It uses risk-free rate, okay, as baseline. It measures the total risk. It measures the total risk using the standard deviation. How do we calculate it? We write the portfolio return. We subtract the risk-free rate and we divide it by the standard deviation of the portfolio, right? So this will give us the Sharpe ratio. So remember, if the question asks about Sharpe, you always look for risk-free rate and standard deviation. If you see beta, that is basically for trainer ratio. Now friends, have a look at the next question. So the next question is another based on commercial paper CP. So question is ABC Limited and reputed Indian corporate with net worth of 200 crore. They plan to raise short-term working capital via the issue of commercial paper. Okay, the company already has a standard fund-based facility from a leading public sector bank. ABC Limited has a credit rating of A3 and they want to issue CP worth 10 crore with maturity of 90 days in demat form. They appoint a scheduled bank as the issuing and paying agent, that is IPA. After 40 days, ABC Limited wishes to buy back the CP from the investor. So basically every aspect has been taken care of in this particular scenario, right? So basically they have a net worth of 200 crore, right? They want to raise money via CP, and they have a standard credit rating of A3. They want to issue CP worth 10 crore, maturity 90 days, demat form. Okay, they have appointed IPA. After 40 days, they wish to buy back the CP. Now the question is, which of the following conditions make ABC Limited eligible to use CP? Option A, net worth of 50 crore and a bank loan under default. Option B, net worth of 200 crore and a standard fund based facility. Option C, credit rating below A3. Option D, no working capital sanction from any bank. So basically, if we talk about this CP, which is a commercial paper, so commercial paper is short-term IOU. It is a kind of short-term IOU. Basically, who issue it? Company issue it, right? To borrow money. Why company issue it? Company issue it to borrow money for a few months, usually up to 1 year. Usually up to 1 year without giving a collateral. But because it is unsecured, yes, it is unsecured. Because it is unsecured, only company with a strong financial can issue it. There are some eligibility criteria. So minimum credit rating is A3, right, or better. Minimum credit rating is A3 or better. And first point. Second point is they must have a standard fund based facility. This is very much required. A standard fund based facility, right, it is required from a bank. And the third point is, suppose it is corporate, suppose it is LLP, or suppose it is a trust, corporate, LLP or trust. So net worth must be 100 crore or more. So these are the three conditions which make ABC Limited eligible to issue CP. First of all, credit rating of A3 or more. Second point, standard non-default fund-based facility from a bank. And for corporate, LLP and trust, net worth must be 100 crore or more. So let's look at the option. Option is a net worth of 50 crore. No, RBI required minimum 100 crore as net worth. 50 crore is too low. And if the bank loan is under default, the company is clearly not financially healthy. What about option B? Net worth of 200 crore and standard fund based facility. It is perfect because ABC Limited has 200 crore net worth, a standard bank facility, credit rating of A3. So all eligibility box are ticked. So yes, this is a criteria. Credit rating below A3, they are ineligible because A3 is the minimum accepting criteria. A3 is the minimum accepted criteria. Anything below A3 like B or C, it means high risk. And then we have option D, no working capital sanction from any bank. This means company has no verified credit track record. Company has no verified credit track record. So RBI want company to have an existing fund based limit. It shows the bank has checked them, so this condition also failed. So let's summarize the point. First of all, what we talked about is the CP is a kind of short-term borrowing tool for financially sound company. And I told you the eligibility rule. The first one is that its net worth must be greater than or equal to 100 crore. Second point is that its credit rating must be more than A3. Third point is that it should have a standard bank fund based facility. It should have a standard fund based facility. Okay, so remember, if a company want to issue CP, it must be financially strong, not just big. Now friends, have a look at the next question. So the next question is, this question is also related to the same case study. It is asking you, what is the minimum maturity and the form of issuance required for ABC Limited CP? CP means commercial paper. Option A, 30 days physical certificate, 15 days demat form, 7 days demat form, 1 day physical certificate. So I told you this CP is a commercial paper. It is a kind of short-term borrowing tool used by company to raise money quickly. It is usually used for working capital need. And it is unsecured. It is quite unsecured, meaning no collateral, and it is issued at a discount for a fixed maturity. And as per RBI guideline, the minimum maturity for CP is 7 days and the maximum maturity is 1 year, right? So, and one more thing is that CP is issued in demat form. CP is issued in demat form. Demat means electronic form, especially since bank can only invest in demat CP. Now let's look at the option. Option A says that 30 days physical certificate. So 30 days within the allowed range, but there is a problem that physical certificate are not the norm anymore. right? CP are issued in demat form only. Option B say 15 days and demat form. Yes, it is correct. Demat form is correct. But minimum maturity should be 7 days, not 15 days. Right. So option C, yes, option B is also not the correct one because demat form is correct. Option C is 7 and demat form. Yes, this is the absolutely correct answer. This is the perfect answer. Minimum maturity, just told you 7 days, and demat form, yes, this is very much important. So what we learned from this discussion is that commercial paper is a short-term money tool for a company. Minimum maturity, I told you, it is just 7 days, and it is issued in demat form only. Right. Bank can invest in CP only in demat form. So the final answer is option number C. Now friends, have a look at another question based on the same discussion. ABC Limited buyback the CP 40 days after issuance. Which of the following is true? Option A, that this buyback is allowed as minimum 30 days have passed. Option B, buyback is invalid as CP cannot be repurchased. Option C, buyback must be done at face value only. Option D, buyback must be done on 90 date only. So tell me, so ABC Limited buyback the CP 40 days after issuance. So which one is correct? Let's first understand, can a company buy back it on CP? This is the question. Can you buy back on CP? Can you buy back on CP? See, the answer is yes. Yes, company can buy back their own commercial paper before maturity, but only under certain condition. The condition is that the commercial paper must be at least 30 days old. The commercial paper must be at least 30 days old, right? And the buyback should happen through the secondary market. This is another condition, that buyback should happen through secondary market, not privately. It should not happen privately. So these two conditions must be fulfilled. First one I told you, it should be 30 days old, CP must be at least 30 days old, and the second condition is that buyback must happen through the secondary market. It should not happen through privately. Now as per the RBI rule, you must remember that buyback of CP is allowed through secondary market only. First point, it must be done after 30 days from the issue date, and you know it is always done at the market price. It is always done as the market price, not necessarily at the face value. Now in this case, what we are observing is that CP was issued for 90 days, right? CP was issued for 90 days. As you can see in this particular question, let me come back to this particular question. Let me show you that here you can see that CP was issued for 90 days. As you can see, maturity is 90 days. And ABC Limited want to buy back on day 40. Yes, ABC Limited want to buy back the CP from investor on day 40. Since 40 is larger than 30, so the buyback is valid. Because I told you, na, minimum 30 days, right? It must be done after 30 days from the issue date. After 30 days. And yes, it is being done after 40 days. So obviously it is valid. Before 30 days, it is not valid. Now, in this case, CP was issued for 90 days. ABC Limited want to buy it back on day 40. So obviously, let's go through each and every option. So option number A say, the buyback is allowed at the minimum 30 days have passed. Yes, this is correct. As per RBI guideline, buyback is only allowed after 30 days. Since 40 days have passed, this is absolutely valid. What about option B? Buyback is invalid as CP cannot be repurchased. What do you think about it? See, this is wrong. Why it is wrong? Because CP can be bought back, but through the secondary market and only after 30 days. So this statement is not correct because it is saying that buyback is invalid. No. Buyback is not invalid. Rather, it can be bought back. Option C say buyback must be done at the face value only. Totally wrong. Because CP is traded in the, it is talking about face value. See, you know, CP, they are traded in the secondary market. They are traded in the secondary market, right? And the price constantly fluctuate. So buyback always happen at the market price. Remember, buyback always happen at the market price, not face value. Then option number D say buyback must be done on the 90 day only. This is also wrong. Totally wrong. Because CP is mature on the 90 day, but company are allowed to buy it back before, as long as 30 days have passed. So the day 40 is fine. So let's summarize what we learned from this particular question, because learning is very much essential. I told you that CP can be bought back by the issuing company. Yes, issuing company can buy back the CP. This is the first point I told you. Second point I told you that buyback must happen after 30 days. Third point I told you, the buyback is done through the secondary market. Remember, buyback is done through the secondary market and it is done at the market price. So someone asks you whether buyback is possible at the face value. No, remember, buyback is not possible at the face value. And the fourth point is I told you, no need to wait until maturity. No need to wait till maturity. You need not wait till maturity, right? So I told you in this particular case, since 40 days have passed, so buyback is allowed. So the key takeaway is that the buyback of CP is allowed, but not too early. Wait 30 days and then go to the market. Simple. I hope that makes sense. Right. Now the last question of this particular case study is that, as you can see, why might a bank choose to invest in ABC Bank CP? Option A, CP has high credit rating but long-term maturity. CP is risk-free and interest-free. CP offer higher yield than interbank money market with short-term credit exposure. Option D, CP is a physical security with high liquidity. Now the very good question it is. Let's first understand what is CP. I told you it is a kind of short-term debt instrument issued by company to raise money quickly. And why bank prefer CP? Because it offer better return. CP, CP offer you better return. It offer you better yield as compared to call money, as compared to overnight lending. So if you compare to call money, if you compare to overnight lending, this CP is offer better yield, and the credit risk is short term. Yes, the credit risk of this CP is very short term. Okay, and it is a kind of tradable instrument. So there is a good liquidity. Let's go through each and every option. If you go through the option number A, it says that CP has high credit risk but long term maturity. It is completely wrong. Why? Because CP actually has low to moderate credit risk, and it is a kind of short term instrument. It is usually 7 to 365 days. So this statement is incorrect. Option B say it is risk free and interest free. It is again wrong. CP is not risk free. Though it is issued by top rated company, there is still some credit risk. Also it is not interest free. It is issued at discount and redeemed at face value. So investor earn interest indirectly. Option C say it offer higher yield than interbank money market with short term credit exposure. Try to understand. CP usually give better return than call money or interbank lending. And since CP mature in a few week or month, the credit exposure is short term, which reduces the risk. Let me give you one example. For example, suppose that interbank call money rate. Suppose interbank call money rate is 5%, and suppose CP is offering you 6.5%. So the bank earn more, right? So the bank is earning more. Bank is earning more by investing in CP with only 90 days exposure. And option D say CP is physical security with high liquidity. This is partially wrong. Yes, CP has high liquidity, but it is not a physical certificate anymore. I told you already, it is always issued in the form of demat form. So let's summarize the point which we have just covered. First of all, why bank invest in CP? Because it offer higher yield than short-term bank-to-bank lending. And credit risk is low, right? And it is only for short time, limited to short period. And CP are quite tradable, right? So bank can sell them before maturity if needed. And CP is always issued in, demat form. So option C is the correct answer. Now friends, have a look at this question. From bond, many questions they are asking, right? In this question, they have provided you the data like, face value, they have given 1,000 rupees. Coupon rate, they have given 12%, and it is paid semi-annually. And 3-year maturity is there, right? And the required rate of return is 10%. So they have asked you to calculate the value of the bond. So friends, how to calculate the value of the bond? First of all, what is the face value? Face value of 1,000. What is the coupon rate? Coupon rate is 12% annually. So which means 6% every 6 months or every bi-yearly. So what will be the coupon payment? If you calculate the coupon, it will be 1,000 multiplied by 6%. Okay, that will be how much? 60 rupees every 6 months. Now what is the maturity? If you look at the maturity, I think it is 6 year, but it is 3 year, sorry. It is 3 year. So it is 3 year. How many period are there? 3 multiplied by 2. So there are 6 periods. Okay, 6 half-year period. And what is the required rate of return? What is required ROR? So required ROR, as you can see, is 10%. Required ROR is 10%, and that is per annum. And we want to calculate it after 6 months. So it will be 5% every 6 months. So everything you have to compute 6 month basis. Now we will use the present value formula. So bond value it can be categorized into 2 parts. First of all, what do? You calculate the present value of coupon payment, all coupon payment plus That is called annuity. So in that case, you apply the annuity formula to calculate the present value of all the coupon payment. And then you calculate the present value of the final principal amount. You calculate the present value of the final principal amount. That is called lump sum. That is called lump sum. So now in the question, they will provide you present value interest rate factor. So let me give you, so they will give you PVIFA. That is called, present value interest rate factor. Please remember. So PVIFA 5% for 6 month coupon is, they have given you 5.0746. This data will be given in the question, don't worry about that. And PVIFA for 5% interest at 6% at 6 month coupon, they have given you, try to understand, this is PVIF, present value interest rate factor, and present value interest rate factor annuity. So these are two different. So they have given you 0.746. Now this data is available. So what we will do to calculate the, so we will calculate separately. Let's calculate the present value of coupon. How do we do that? So multiply this 60 rupees with 5.0746. Okay. So with the PVIFA, how much you will get? So you will get 304.48. 304.48. So this is the PV value of the coupon. And what is the PV value of the principal? What is the PV value of the principal? So that is nothing but 1000 rupees multiplied by 0.746, which is nothing but 746 rupees. So the total value of the bond, total value will be the sum of these two, which is 304.48 plus 746. And if we add both of them, we will get 1050.48. Right? If you go through the option, so nearest option is option number B, and yes, it is the correct answer. So friends, remember, let's summarize what we learned from this question. You know that bond pay rupees 60 every 6 months for 3 years. What we do, we discount those cash flow using the required return. And what is the required return? Required return is 5% per period. We add the present value of all the coupon payment, and we add the present value of the face value. And we use this PVIFA and use this PVIF from the standard table. There is a standard table, and in the examination they provide you the data. And remember, if the coupon rate is larger than the required rate, so bond always trade above par, and you can see bond is trading at 1050 rupees. So remember, if the coupon is more than the required rate, the bond price goes above rupees 10,000, right? So friends, I hope this concept is clear now. Now friends, if you really think that this video is adding values to your preparation, please hit that like button. This will encourage me to make more such and such content, right? Now friends, have a look at the next question. The next question that we have is related to Mr. Raj. Mr. Raj is a corporate treasurer. He is managing a 10 crore floating rate loan, right, which is linked to 6-month LIBOR. He is concerned that interest rate may rise above 7%, which could increase his interest expense significantly, right? So he feared that interest rate may rise above 7%. So what he did, he buy a interest rate, cap with a strike rate of 7%. One of its settlement period sold LIBOR at, one of the settlement period sold the LIBOR at 8.5%. Okay. Now as you can see, one of the settlement period sold the LIBOR at 8.5%. Now the question is, what is the main purpose of the Mr. Raj buying an interest rate cap? Option A, to benefit from falling interest rate. Option B, to protect against interest rate falling below 7%. Option C, to reduce loan principal. Option D, to hedge against the rising interest rate above 7%. This is a very good question. Now the question is, what is the meaning of this interest rate cap? See, this is like, insurance policy. This is like, insurance policy for whom? This is insurance policy for borrower, right? It set a maximum limit, and that maximum limit we call the strike rate. That maximum limit we call the strike rate on how much interest they have to pay on a floating rate loan. So they set a maximum limit on how much interest they have to pay on the floating rate loan. In this case, as you can see, Mr. Raj, he has 10 crore loan. Mr. Raj has 10 crore loan. It is linked to 6-month LIBOR. It is linked to 6-month LIBOR. And suppose LIBOR rises above 7%. If LIBOR rises above 7%, so the cap kicks in. Cap kicks in, right? Because they have set the cap at how much? They have as you can see, they have set the cap as 7%. Yes. So if the LIBOR increase 7%, cap will kick in, right? So he will only pay up to 7%, and the difference, suppose the rate as you can see is 8.5%. So what is the difference? 8.5 minus 7%, which is how much? 1.5%. So this 1.5% is paid by the cap seller. This will be paid by the cap seller, right? So that is the point. Now let's go through each and every option. Option A, to benefit from falling interest rate. See, cap don't help with the falling interest rate. See, if the interest rate fall, right, Raj pay lower interest anyway. That is the benefit of a floating rate loan. The cap only have help when the interest rate rise. Option B, to protect against interest rate falling below 7%. This is again wrong. That sound more like a floor, not a cap. Cap help when the rate go above a certain level. Floor help protect the minimum interest income, which is not the case here. To reduce loan principal. Again, it is completely incorrect. Interest rate cap has nothing to do with principal. They only manage the interest payment risk. Option D say to hedge against rising interest rate above 7%. Yes, this is the perfect. That is exactly why Raj bought the cap. He is afraid that LIBOR will go above 7%, which means higher interest outflow. So the cap makes sure that his cost does not rise beyond 7%, no matter what LIBOR does. So let's summarize what we come to know in this particular question. So friends, I told you that we talked about interest rate cap. It is a kind of ceiling. Let's summarize. Interest rate cap is a kind of ceiling on how a high interest rate payment can goes up. In the case of Mr. Raj, you can see he has a floating rate loan. Interest rate move with the LIBOR. He want to avoid paying more than 7%. So he buy a cap at 7%. If the LIBOR go to 8.5%, he still pay only 7%, and the cap seller pay the rest. Now, the question is, how much Mr. Raj receive from the cap in the settlement period when LIBOR rises to 8.5%? Very good question. Right. So friends, let's understand the concept first. When LIBOR rises above the cap rate, and the cap rate is how much? 7%. Right. So Mr. Raj get a payout from the cap seller. Yes, he will get a payout from the cap seller. This compensate him for the extra interest he would otherwise have to pay on his loan. And if you want to calculate the cap payment, this question is most frequently asked. Remember the formula. Just take the notional value, just multiply it by the LIBOR minus the cap rate, just multiply it by days and divide it by 360. Because days to convert into year, we multiply it by 360. Now let's plug in the value. What is the notional value? 10 crore. 10 crore is the notional value. What is the LIBOR rate? So LIBOR rate has risen to 8.5%. What is the cap rate? Cap rate is 7%. So this is nothing but 0.085. This is nothing but 0.07. Now let's apply the formula. So 10 crore, 10, 00, 00, 000 multiplied by 0.085 minus 0.07 multiplied by for 180 days, right? It is clearly written for 180 days. Right, as you can see here, let me write, yeah, number of the days in the settlement period is 180 days. As you can see clearly written. So multiplied by 180 days. Okay, and you divide it by 360. So friends, if you calculate it, this will give us 7,50,000. So Mr. Raj will receive 7.5 lakh from the cap seller. I hope that makes sense to you. So friends, if you want me to continue, please write yes in the comment section. I will discuss the remaining question, because we have a set of very good questions which are taken similarly question were asked in the examination. So if you want to get such kind of PDF, you can WhatsApp me on this particular number, or you can enroll in our CTP course. Thank you.